We've got to talk about retail investors now and what the heck is going on with retail and positioning. And we happen to have a report on just that from Vanda that's going to provide us some incredible insights on what's going on with retail. Keep in mind, this comes on the back of already AMD getting downgraded and Logitech numbers not that great. Almost every segment of this computing industry is plummeting. You're down about 20%. However, chip stocks and peripheral stocks actually off of their lows, probably because the stock market has once again overpriced fear. Anytime you have uncertainty and then you get reality, oftentimes stocks actually go up when reality comes out. Not always, especially when it's unexpectedly to the negative side, but usually when people are really fearful about things, it tends not to be as bad as expected. So, what does Vanda have to tell us today? Well, let's find out. The latter stages of an equity bear market or the early stages of a pain trade rally. Either way, U.S. markets last week exhibited wild and at times inexplicable swings. In this week's positioning update, we'll take a look at how investors are positioned ahead of peak earnings. Upcoming catalysts that we are watching. Number one, as we enter peak earnings season, the focus for equity investors has shifted towards gauging the size and timing of the forthcoming U.S. recession. This is true. We have seen a substantial shift away from, for example, monitoring what the Federal Reserve is going to do when it comes to rates or what's going on with inflation. Now everybody just cares about earnings per share, which is frequently deemed to be the second half of the cycle. Now, what's really remarkable here is that if we do just, for example, take a quick little peeky-deeky over here at, at this, what we find is that we actually have a now 42% probability that interest rates are not going to lift off at all from 4.25. That so much bad data has come out that the Fed's not even going to be able to, forget 5%, forget 4.75, they can't even get it up off 4.25. Imagine that. Fed can't get it up. I don't think J-Powell's going to be too happy about that characterization. Anyway, so here's some catalysts. Widely anticipated Q4 results for Microsoft today, Tesla Wednesday, Chevron and healthcare names also. But do keep in mind, I hope to stream Microsoft at the closing bell today, though I might have to unlist that live stream afterwards if you do come. And keep in mind, January 30th, mark your calendar for that as a catalyst for the expiration of the coupon code, which comes just a day before the Employment Cost Index report, something the Fed's going to watch pretty clearly. Next fortnight, next 20 days here, we will see U.S. equities entering peak earnings season with buybacks not in play until the first half of February. Now, that's actually a big deal because when you get companies in a blackout period, it means they can't buy or sell stocks. And if their stocks are potentially deemed low based on the earnings they put together, the company can't actually go buy the dip before the rip because they're in a blackout period. Which means we're really not going to see companies be able to buy back stocks if they are so inclined until on average about mid-February. So that actually potentially means that we're in a period of low buying pressure right now, which is kind of remarkable because stocks have kind of been trending up. So imagine if you got buyback buying pressure as well on top of that. Interesting to note. When looking at where investors are hedged for bad news on the earnings front, we see the biggest puts taken out across industrials and staples in recent weeks. This is the call to put ratio here. And when it's negative, it means there are more puts. And right now it looks like the biggest puts, and this is actually surprising to me, are on industrials and staples. Now, staples and utilities, keep in mind, have done very well in 2022. And those are actually the ones with the biggest amount of puts on them right now relative to call options. Tech, obviously, also substantially more puts than calls. Some folks are suggesting that's why we're potentially seeing a little bit of a squeeze led by tech. However, other sectors actually have more shorts against them. CarMax, Nike, McDonald's. McDonald's, by the way, has done very well year over year as a stock. Financially, though, and fundamentally, not actually that good. And I will say, Red Robin, as just sort of a comparison to McDonald's, does not really franchise. I don't think it franchises its restaurants at all. And they're losing money hand over fist. I was at a Red Robin yesterday, and I hate to say it because I used to work at Red Robin like 16 years ago. It was not good. First of all, the restaurant was like nearly empty, barely people coming in around dinner time. And on top of that, I think because so few people were there, you actually saw them providing less quality food, like old oils for grease, for mozzarella sticks or French fries. And I'm like, what are you doing? That's like the staple here. You should have fresh French fries. And so kind of disappointing, but you see that kind of stuff going into a recession. You see restaurants start seeing numbers go red, and then they start cutting corners, and then numbers go even more red. But anyway, CarMax, Nike, McDonald's, Tesla, Apple seeing big hedges put on, clearly fears around the U.S. consumer. This is where we're seeing the top hedges in S&P companies. Big ones again here. CarMax, Microchip, we got Nike, McDonald's, Devon, Kraft, Newmont, Tesla, Kinder Morgan. Ooh, big Tesla shorts here. That'll be interesting. Advanced Auto Parts, Apple, Halliburton. Releases so far confirmed that discretionary investors are broadly underweight U.S. equities. Yep, that's true. A lot of money sitting on the sidelines. Even Goldman told us that last week. A lot of money waiting to be deployed on the sidelines, waiting for proof that, the pain is over and it's time to go rally. Excuse me. Firms with strong earnings seeing the highest excess returns since the second quarter of 2019, pointing to light equity positioning. Okay, in English, when stonks do good, they go up real fast, implying a lot of money, again, sitting on the sidelines. If earnings hold up in the coming weeks, we may see equity bears shift their focus to debt ceiling concerns. Okay, this is actually the most hilarious line. Shout out to the writers at Vanda Track. This is probably the most hilarious line I've ever seen somebody say about bears. Basically, as soon as the last remaining holdout for bears to say everybody should be bearish goes away, aka if earnings aren't that bad, they'll have to find something else to bitch about. And they'll just complain about the debt ceiling. That's a good one. However, overall, S&P 500 performance has been mixed ahead of previous major government shutdowns. And obviously, we don't actually expect anything to happen with a government shutdown. Run up to prior government shutdowns show mixed S&P 500 performance. Clearly a flight to safety in bonds. Fine. Who's been behind the selling of late? Relatively lackluster retail buying and mutual fund outflows. Explains soggy markets. Now, this is interesting. Mutual fund outflows basically suggesting, hey, look, a lot of people do this, and I saw this with I hate to say it, but I saw this with family members in 2009. At the bottom of the market, they're taking their money out of mutual funds because they're like, man, my mutual fund manager sucks. I'm taking my money out. And they literally withdraw, redeeming their money at the frickin' bottom. All right, what else? One of our two conditions for a bottom in U.S. equities is a capitulation in defensives. Well, we haven't seen that yet, although there were some signs of this last week. Really? Cyclicals have accounted for the lion's share of selling. Okay, interesting. So defensives would be like healthcare, real estate. Cyclicals could be things like autos, like Ford, GM, right? Interesting. So not actually seeing that defensives capitulation, they're saying, just yet. But you are seeing shorts start loading up on some of these. The other condition for an equity market bottom is clear retail capitulation. That has not happened yet. We have not quite seen fire sales in that mark the end of the Q4 2018 sell-off. This would also usually align with a volatility spike, a VIX spike. This is clearly not the same retail investor that we saw in 2020 or 2021. On the surface, an uptick in retail buying over the past week may point to a renewed animal spirits amongst investors of this cohort, but retail investors always tend to buy big ahead of earnings seasons. Interesting. However, purchases this month have been relatively light for this time of year. Because usually you do see a lot of retail purchases in January after tax loss harvesting in December. This kind of implies a lot of people waiting on the sidelines for potential for us to get through earnings. And again, if these earnings come out good, or at least better than expected, it could kill some of the bear thesis. Anyway, retail typically buys ahead of earnings, but it's been lackluster this year. There you go. You can see the chart right here, pretty dang low. Still, other retail parts of the market have indeed been capitulating, with mutual funds seeing their usual end-of-year outflows. That being said, there could be a lot more pain to come if these funds see a full reversal of cumulative inflows. In other words, a lack of money coming in. Mutual funds likely to be behind recent selling. We talked about that already. Okay. Mutual fund inflows since Jan 2021 still positive. Risk of further unwind, though, because of recession fears. That could create some more selling pressure. When it comes to rebalancing, our models do not point to a massive selling of equities in the next few weeks. Fine. Watch out for commodities traders in the coming seasons, or sessions rather. Okay. What else do we have here? Overall, the sellers are becoming fewer and fewer. We're potentially entering the latter stages of the bear market. The window for a pain trade rally in stocks will be open if U.S. earnings positively surprise. Pain trade rally would be like, hey, things have been so bad, but they're just not as bad as we thought. Equity bulls look to be returning, given that a Fed pivot looks to be in sight. Whilst investors seem to be chasing the low-hanging fruit of positive macro surprises in Europe and Asia, it may only be a matter of time before sentiment spills over to the underweight U.S. equity markets. This is something we actually talked about earlier, that it seems like well, first of all, we've seen the entire world stock market up 19%, whereas the U.S. is just up about 5% since October. So you've seen more bearishness in the U.S. than in Europe and Asia specifically, but also the rest of the world. This is why you have a lot of analysts right now talking up, oh, it's emerging markets, that's where it's at. Whereas I actually have a little bit of a belief that you could look at American companies that have a lot of international exposure, like what I consider pricing power style stocks, Taiwan Semiconductors. You've got Tesla, you've got Apple, you've got Nvidia. These companies have a lot of exposure to international. Global equity positioning up over the past week. Investors gaining confidence, buy the dip. Okay, fine. U.S. tech amongst markets that have seen the sharpest outflows in January. However, with bulls increasing risk in Europe and Asia. That's interesting. Look at that. Bearish positions, U.S. tech down here. EU staples, EU energy. Japan, bearish. U.S. industrials, U.S. energy. Well, that's a surprise. Whereas what's bullish right now? Bullish, you've got Taiwan, Thailand, EU equity, South Korea, Germany. Germany talking about not going into a recession. Ooh, fascinating. This is actually really interesting and kind of aligns with some other data that we're seeing. Let's look at some other data that we have. Retail, let's see here. Retail. Muted purchases by retail in ETFs, which actually indicates potentially a low conviction ahead of earnings. I can go ahead and show this chart right here. This means individual, and I actually mentioned this earlier. Here's just the chart to evidence it. Retail investor net purchases. You can see the blue line is single stock purchases. The red line is ETF purchases, mostly like larger index funds like S&P 500, the triple leveraged S&P 500, triple leveraged NASDAQ, actually seeing lower inflows than single stocks, or some are saying actively managed ETFs seeing more inflows as well because they are more maybe thematic or more single stock focused than these sort of broader, let's just invest in the entire S&P 500. I think what's happening is retail individuals basically are picking which stocks they think are going to do well in earnings and which stocks have potentially been oversold. Let's see here. Market rally potentially coming from institutional investor short covering. ETFs are experiencing the biggest flow divergences since 2022. Oh, wow. Here we go. We actually have a chart kind of showing us numerically where these flows are occurring. I'll go ahead and pull that up. Now, when you look at flows, some of these ETFs aren't going to be very obvious to us what those are. So if you're curious, just take a screenshot. And no, I won't show you a screenshot about that 30% off coupon code that expires, or sorry, it's more than 30% off. The coupon code that expires on January 30th. I screwed that one up. Best coupon code will have 3-month guaranteed price, lifetime access. Pretty great pricing you can get in lifetime access to those programs. But anyway, here you go. You have inflows going into the semis triple leveraged bear index. Wow. Natural gas. Treasuries, it's like cash holdings over here. Whereas you have outflows. Look at where you have the outflows. You actually have outflows on ARK, semis long, Russell 1000s, that's your value. NASDAQ 3X bear, that actually has outflows too. NASDAQ bull has outflows. This sort of reiterates that people, let me show you the rest of the chart there. There we go. This kind of reiterates there. You could take a screenshot like right there. You can see here that it really seems to be the broad-based indices are getting hit. And I'm surprised the bearishness on chips, because I'm actually personally bullish on chips. But anyway, upcoming week should give us a good understanding thanks to earnings. Blended earnings decline for the S&P 500. Q4 is 4.6%. That's the estimate. We'll see what happens. Do keep in mind that retail sales are lagging, right? Holiday sales grew 6.7% from October to December. Sales lagged the average inflation rate of 7.1%. So real holiday sales were actually negative. Probably Q4 was also not as good. You've got the National Retail Federation estimating that holiday sales in November, December grew 5.3%. That was short of the growth estimate of 6 to 8%. So that would be bearish for earnings, right? Q4 will depend on whether or not retailers had to aggressively discount to get their inventory off the shelves. Retail electronic sales expected to be negative 5.6% year over year in December. Again, we saw with Logitech numbers pretty bad. Furnishings and clothing will be interesting as well. We'll see that from American Eagle and Abercrombie. Macy's says there was a lull of sales outside of holiday weekends. I personally sold my stake in Lulu after their margin guide, and they are reiterating pressures today and getting downgrades again today. Personally, I've never seen sales at Lulu, and I hate to say it, but look, I worked at Hollister, so maybe I have this like personal like shell shock to sales, but as soon as Hollister started doing sales, it was downhill from there. Hate to say it. But it's something to pay attention to. Who knows? Maybe it's just a sort of seasonal, and they were just getting rid of some of their excess inventory, and now they've stabilized. Who knows? Something to pay attention to, so I would watch that at Lulu, since they're generally not a company that's been known for sales. Real disposable income has been deeply in the negative territory. Yep. Job openings and wage gains have moderated from Fed tightening. Savings are depleted, and consumers have either cut back on spending or turned to credit cards. Now, of course, we'll see whether or not retail sales actually hold up, but important things to pay attention to. So that gives us a little bit of insight here into retail, where the positioning is going, where buyers are going. In my opinion, this earnings season is critical, and it makes sense for stocks to actually trend down slightly before earnings. So I was a little bit surprised with that large rally we had on Monday, especially since usually before the news comes out, we don't get the big rally. Who knows, but I'll never forget the early part of 2022 when we started seeing those bad Netflix earnings, and it was the canary in the coal mine for bad news coming forward. This time we've actually had better than expected earnings coming out. Pretty much everywhere except the real estate sector and some of the discretionaries. Real estate, for example, D.R. Horton, massive miss. Contracts falling 38%. Huge under-expected result for contracts, 13,382 versus 14,528 expected. They're, of course, blaming mortgage rates. But it's no surprise that real estate is getting whacked, and we expect to see the worst of the numbers coming up here within the next 2 to 3 months once the Case-Shiller actually catches up to negative year-over-year numbers. Some thoughts here on retail. Bitcoin trying to go positive here, still sitting slightly negative, so we'll see how stocks end up moving. But I don't know. Let me know in the comments. What do you think? What's your retail positioning? Are you kind of like a lot of retail right now where you're staying away from those broad-based indexes and you're kind of waiting to see what happens with earnings, and you've got money on the sidelines from stock loss harvesting and you're ready to pile in? That's what VandaTrack is arguing, that maybe we could actually have a big bull movement and the bears are going to have nothing left to talk about but the debt ceiling crisis. Kind of crazy, something to pay attention to, and I kind of hope VandaTrack is right. Anyway, let's go ahead and jump on over and see if we've got CNBC covering anything entertaining. Nope, we've got an ad. Okay, well, that's boring. Fine then. We'll look at something else. So, let's see here. Let's see. What news do we have? Okay, we have PMIs coming out in about 30 minutes. We'll be covering PMIs in the Course Member Live. We've got break-evens on the 5-year, pretty stable right now, 231. We have Future still slightly negative. Industrial earnings disappointing. Some pullback in U.S. futures after the sizable rally of the past 2 trading days. Unsurprising. Well, yeah. Semiconductors got a lift Monday after Barclays upgrades, although AMD is down pre-market after Bernstein downgraded the stock. ChatGPT, Microsoft billions may be good for NVIDIA. Hey, I made a video about that yesterday. ChatGPT is wild. Absolutely wild. Divergence between markets and economy cheapens recession hedges. Economists tend to overestimate GDP more frequently by a greater magnitude in recessions. Markets, therefore, do not adequately reflect downside risk before a downturn hits. Put spreads on the retail and high-yield credit are among attractive recession hedges for portfolios. Wow. Okay. Put spreads on the retail sector. Markets are implying the odds of a recession are falling. While they can influence economies in various ways, such as the availability of credit and wealth effects, it is not easy for them to reverse many months of economic damage through this crazy hiking cycle we've been through. Yeah, no kidding.